Hello everyone, welcome back to STA Club, the club for stocks trading and analysis. This channel is dedicated to provide you with a high quality tutorials, guides and insights that demystify the world of trading. Whether you are a beginner taking your first step in the financial markets or a trader looking to refine your strategy, there's something here for you. If you have ever found yourself lost when staring at those complicated candlestick charts and do not know what the meaning of that chart, wondering if they hold the key of your trading success, and would like to know more about technical analysis, you are in the right place. In today's video, I'm going to reveal the ultimate secret weapon of successful traders and teach you how to read the candlestick patterns. By the end of the video, you will possess the skills to decode the market language like never before. You will be able to read candlestick pattern and use it like a pro. So before we start the topic, do you know what is technical analysis? So technical analysis is the studies of past price and their patterns to predict future price. Usually news, forecasts, sentiments and future expectations are reflected in the price of the stocks. Therefore, by using technical analysis, we are able to increase our win rate during trading. Compare with reading the financial report of a company. Looking at the chart will give you more real-time data and insight into the stocks for a short terms. Sometimes it only takes one glance at the charts, then you will know when you can buy and sell and whether the stocks is at uptrend or downtrend, because the chart can give us information which sometimes you never get it from anywhere. In this video, we will focus more on the basics of technical analysis, on how to read a candlesticks and what is the bullish and bearish signals you need to look out for when you look at candlesticks. And we are not just decoding candlestick pattern, we are looking at the psychology of the markets, which can supercharge your trading strategies and increase the win rate for your tradings. Without further ado, let us start with how to read the candlesticks. A single candlestick on a chart represents the price movement during a particular time interval, which could be as short as a minute or as long as a month, depend on the chosen time frame. The candlestick's box portion, which is either green or red, is referred to the body. The candlestick with the green body is known as a bullish, while the red one is known as a bearish, and the one with the line is known as neutral. The line on either end of the bodies are referred to the wick, or we can call it shadows, represent the high or low range for the time period. Every candlestick's formation has an open, high, low and close, which refer to the stock's price. So there will be some difference when we look at the candlesticks with different colors. When we look at the green candlestick, it is called a bullish candlestick. The bottom end of the body would be the opening price and the top end would be the closing price. The wick shows the price has been to the particular price during the time frame of the candles. The upper wicks indicate the highest levels of the price reached before it goes back down, and the lower wick will be the opposite of the upper wicks, which is lower levels of the price reached before it go up. So the wick gives you a quick picture of how crazy the price goes. Did it go really high or really low during that time? It's like the candlestick's ways of telling you a little story about what happening in the market. They will be a little bit different from the red candlesticks, which we call the bear candlesticks. The top end of the body will be the opening price and the bottom end will be the closing price. It will be the opposite with the bullish candlesticks. The one with a line candlestick is called a doji candlesticks. A doji candlesticks appear when the stock openings and closing price are almost the same. When you see a doji, it is like the market is giving you a puzzle to solve. Sometimes the doji suggests the price might change directions. It is like a sign saying, watch out, things might turn around. But other times, it is like the market is confused and doesn't know which way to go. A doji candlestick can give us hints about possible reversals in the trends, or they could show that the market is unsure about where the price will go. So the bullish, bearish and doji candlesticks would be the foundations of the candlesticks that you need to know. Besides from the shapes and pattern, it's important to look at the length of the candlesticks. Different candlestick length will have told a different story. The longer length of the bodies of a candlesticks has stronger signals to tell whether the market is more bullish or bearish. The length of a candlestick body represents the distance between the closings and the opening price during a particular time period. Long body imply a strong directional movement, while short bodies are an indications of indecisions among investors in the market. So this candlestick is called as actually bullishness, which show the strongest signals, and followed by this one, which show the strong one, and then move to this one, which show the weak one, and last will be the doji candlesticks, which is considered as no directions, as what I just mentioned, and same goes to the bearish candlesticks. So we have learned the most common candlesticks and functions of the length of the candlesticks. Now is the time to know more candlestick pattern that will give you the bullish and bearish signals. From these pictures, we can call these candlesticks hammer or hanging man candlesticks patterns, which will be the most common and easier to provide a useful signals. It will be called a different name in a different situations. One will be a bullish signals and one will be a bearish signals. So first, let us start with the hammer candlesticks. A hammer patterns happen when price drop, but by the end, buyer fight back and bring price up close to where they started. The wick is more than twice the size of the body. A hammer candlestick usually suggests a possible reversals in the price trend, but this isn't certain until there's a confirmation signals. The next candle need to be a bullish candlestick close higher than a hammer to act as a strong confirmations. Trader will often decide to buy more or less after these confirmations. They might set a stop loss below the lowest point of the wicks of the hammers. Later in the last parts of the video, I will show some example on how to catch the trend reversals by looking at the hammer candlestick and the confirmations candles. So stay until the end and make sure you don't miss. On the other hand, the hanging man pattern looks similar to the hammers, but it appears after an uptrend. Hanging man suggests a potential reversals in an uptrend. It's like a signal that the bull might be losing their grip. The long lower shadows indicate that the seller pushed the price up significantly during the sections, but then buyer managed to push it back up to closer near the opens. Once you spot a hanging man patterns, the next step is to seek for confirmations, looking for follow-up signals. Usually it is in the form of bearish candlesticks to strengthen the case for the potential trend reversals. The hanging man and the hammers are both candlestick patterns that indicate trend reversals. The only difference between the two is the natures of the trend in which they appear. If the pattern appear in a chart with an uptrend indicate a bearish reversals, it called the hanging man. If it appear in a downward trend indicate a bullish reversals, it is hammer. Apart from this key difference, the patterns and their components are identical. Next will be the inverted hammer, or we can call it shooting stars. Very similar to the hammers and hanging man, it will have different names during different situations. An inverted hammer is a candlestick pattern that appears on the price chart when there's a push from buyer to raise the price of the stocks. It often emerges at the bottom of a downtrend and suggests the possibilities of a shift toward an upward trend. The formation of inverted hammer candlestick occurs when bullish traders gain confidence. The upper wick's top part is created when buyers drive up the price as high as possible. The lower part of the wick is a result of short selling resisting the highest price. However, the bullish momentum prevails and the market settles at the highest price. An inverted hammer is like a warning sign that the market dynamic might be shifting. It is a call to attention for traders to assess the potentials for the trend reversals. Once you have identified an inverted hammers on your price charts, it is always important to seek for the confirmations. You need to look for a bullish candlestick that forms after the inverted hammers. This bullish candlestick should ideally open higher than the inverted hammers close and continue to rise, showcase the potential strength of the buyers. However, inverted hammers aren't usually enough on their own. It requires more confirmation from other technical skills to increase our win rates. For example, looking at the support and resistance is always important. You also can use some indicator to be more sure of the patterns. If you would like to know more about all this topic, like and comment below. Let me know what technical skills you would like to learn next. I will try my best to do more interesting and useful videos in the future. Why reversal? A shooting star show up at the end of an uptrend and signal a potential bearish reversals. It is like a signal that despite price soaring high, there might be a warning, bear might be starting to challenge the trend. The long upper shadows indicate that buyer pushed the price up significantly during the day, but then seller came in and pushed it back down. If you notice there is a shooting star showing up in a relatively strong resistance, you might need to be careful because the price might be at its top and a potential trend reversal may occur. The confirmations could be bearish candlesticks that form after the shooting star. The following candlestick should ideally open lower than the shooting star, close and continue to decline, showing case potential selling pressures. So these four patterns we have introduced in today's videos: hanging man, hammers, inverted hammers, and shooting star might seem like siblings due to their similar shapes, but they actually show up in different market scenarios. All four of these patterns have common themes which require confirmations to identify trend reversals. It is like waiting for the next scenes in a movie to make sure the story is on track. Think of it as a teamwork. Each pattern needs its partner to step in and validate the narrative. So while this pattern offers useful signal, it is the confirmation that truly seal the deal and let you know if the plot is unfolding as anticipated. Combining this pattern with their confirmations partner can help you to make more confident trading and decisions in the stock market. After the theory of candlestick, let us move to the most important part, how to use candlestick to find the bullish and bearish signals. Last few months, everyone has been talking about AI stocks, and the market is optimistic about the future of AI. In this case, it has bumped all the AI stock up. Nvidia alone went up more than 300% from its bottom. So by using technical analysis and looking at the candlesticks, you are able to catch the trend of the market and increase the probability of winning. Okay, so now let me show you the power of candlesticks. Before the price of Nvidia pumps up, it has some signal showing the price might be at its bottom based on the candlestick chart patterns. So from the bottom, we can see an inverted hammer and cross candlestick patterns with a confirmation showing a bullish signals in Nvidia price. Okay, look at here. We can see two doji, and next day we see a bullish candlesticks. This can be a form of confirmation. As per this video, this bullish candlestick has a very strong signal as the length of the candlestick is very long, and also the closing price of the bullish candlestick is higher than the previous day candlesticks a lot more. So the signals of the potential trend reversals is high. Next, move to the bottom here. You can see there's an inverted hammer emerging at the bottom of the Dow trends, and the confirmation next day is a gap up bullish candlesticks. In this case, it shows confirmations of potential trend reversals. So a gap up candlestick specifically refers to a scenario where the openings price of the current candlesticks is higher than the closing price of the previous candlesticks way a lot, which you can easily spot it on the chart. So after the gapping up confirmations, the stocks has gone sideways for a few days. This scenario in the actual trading is very common. Therefore, we need to have a very clear strategy to set our stop loss after we spot a trend reversal signal. The specific distance for the stop loss should be determined based on your risk tolerance and trading styles. If you are comfortable with higher risk, you might set the stop loss to the wider buffers, whereas a more conservative approach might set the stop loss closer to the patterns. Remember, having a clear trading strategy includes entry and exit point, stop loss placements, and risk management is essential for successful trading. It is also important to adapt your strategy to your individual risk tolerance and market conditions. So we have seen the example of the bullish trend reversal from Nvidia. Let us look at another hot stock, which is Unity. You can see that the top of Unity always has a very obvious shooting star with confirmations. So you can see there are 1, 2, 3 and 4 shooting star here, and followed by doji at the end of an uptrend, which signal a potential bearish reversals. From a chart of Unity, when you see shooting star and confirmations form in the uptrend, the price has higher chance to drop. In this case, we can try to decrease our exposures of these stocks, or do not FOMO, fear of missing out, and rush in to buy the stocks. While candlestick pattern can provide valuable guidance about potential price movement, they do not guarantee a specific result. These patterns serve as a tool for us to assess market sentiments and make informed decisions, but other factors can also influence price behavior. Relying solely on a single candlestick chart pattern is not always sufficient to confidently predict a trend reversal. It is important to consider additional factors and wait for confirmations before making trading decisions. Just like one piece of puzzle may not reveal the whole pictures, one candlestick on its own may not provide a complete understanding of market dynamics. So we need to always combine candlestick patterns with other technical indicators, trend analysis, and trading strategy to make well-informed decisions. Think of it as a gathering multiple pieces of evidence before concluding. Candlestick pattern offer valuable insights into market behavior and help traders make more informed decisions. So stay tuned, because in the next video, we will cover more powerful candlestick patterns and secrets that could potentially boost your trading knowledge and skill. It will be the end of the video. If you like the video and think this video has been very helpful to you, smack the like button and subscribe to our channel so that you will not miss our latest video in the future. Comment below to any technical analysis skill you want to learn. Thank you for the like and share. See you in the next video.